right. Morning everyone. Welcome back to our morning kappa at 8. I'm Joseph here. So, while we were at the holiday yesterday, what we do see here is that the Hong Kong market experienced a fresh selling pressure yesterday, and the Hang Seng have a deep lower like yesterday. Based on the evening sessions, the index continue to chart a fresh lower low. So if today 4 p.m. Hang Seng failed to reverse on the upside, then on Hang Seng would have underwent correction for the third consecutive sessions by today, 4 p.m. So we just keep a bearish bias on the Hang Seng index, but we do see that well, the market having a cautious sentiment right now among the blue chip stocks in the Hang Seng Index. 981, the Zhongxin Guoji, which is a semiconductor manufacturing international, have been bucking the trend, went up by 2.36% yesterday. So based on the chart, you can see that the SMIC is about to have a breakout based on yesterday's price actions. So if the breakout happen, 981 or SMIC would be move higher. So right now, we do see on the heat map, right, most of the Hang Seng stocks experiencing different degrees of selling pressures. Right now, only the 981, 1024, and the 2382 bucking the trend, moving on the upside. Now, meanwhile, A50, look at their price actions. They also underwent a corrections, and A50 also closed below the 20 and 50 days moving average as of yesterday. Despite that, the index A50 index have a negative price actions. You look at the market sentiments in the Chinese market remain risk on so far. Now, based on this trading view dashboard that I see, right, based on the all Chinese companies that comprise of the both Hang Seng as well as the Shenzhen market, right, some of the outperformer can gain about 5.9% as of yesterday. So about one third stocks actually went up. They rebounded by at least 6%. Now, among the counters over here, one actually attracted my attention was the 00725, which is here, this BOE company, which we have highlighted, I think 2 weeks ago, right? We mentioned to you about this company, 000725, Jing Dongfang, that's listing in Shenzhen stock market, this A shares. After a week of corrections, right now it rebound and climb above the breakout point of 6 renminbi 15 cents, testing the first resistance at 680. Right, then on the next R2 will be a 740 and followed by the higher one at 8 renminbi. So you can see that despite that the China A shares the track the biggest 50 largest stocks in Chinese market, right? You can literally see that most of the stock that listed in the Chinese market, they in fact close in the positive territory. So comparing the Hong Kong market as well as the Chinese market, right? I do see that since we have started to talk about the Chinese market for the last 2 weeks, beginning in June, I do see that the Chinese market is actually more bullish than the Hong Kong market, right? If you catch a good correct ones in the China market, right, then on you can see that the momentum is really, really strong, just like what we see in the Jing Dongfang 725, right? Yesterday, the share have moved up by 10%, right? So in China, the limit up threshold is actually 10% per day, right? And US Fed meeting have been concluded for their June meeting, right? And right now, what we are going to look at is how is the traders' sentiment on the FOMC meeting. Now, what have been cast in the stone is that there's no rate hike in the June meeting, but what we want to see is that coming following the July meeting, right? Market is actually pricing a 30% chance that there'll be one rate hike as early as next month meeting, the July, right? And then on, as of the year end target, right? Market is looking at somewhere at 4% to 4.25%. Reason what makes the market have a S&P have a pullback yesterday is that initially, right, more than half thinks that the rate will be stay still at 375 until the end of the year. But right now, half of it have actually moved to one rate hike, or the bulk of it actually tends to believe there will be two rate hike by the end of this year. So chances of rate hike this year have actually increased since the meeting of yesterday night. And as such, when the interest rate are moving up, one of the first impact will be the equities market, and you do see that the those tech stocks have actually pulled back at the US market yesterday, right? Meanwhile, looking at the crude oil, right, this week, crude oil have actually break below the $80 per barrel. And what happened is that since last Sunday, right, Trump has mentioned that he have struck a deal with the Iran, and also based on what the Iran president have posted yesterday, right, he also confirmed that a deal has been reached, but the details have yet to be known. And the next deadline will be on Friday. But you look at the oil market news, some of the LNG tankers start to actually move out from the Straits of Hormuz, right? And some LNG even rushing towards the Strait of Hormuz to reload on the LNG, right? So traffic has slowly moving at the Straits right now, and as such, despite that the war is still ongoing, as what we have learned from a Trump posting, also he have ordered the blockade of US to be removed, right? And that have actually give a negative sentiment, very strong downward pressures on the WTI, and we have since breached the 90, 80, and right now heading towards 70. And we keep a bearish bias on the WTI with our stop loss at $100 per barrel. And meanwhile, the gold have rebound yesterday to 4,004, but since the inflation's pressures are coming in, right, the yield on the bond are actually moving upwards. That have also a bit of negative impact on the gold. As such, this morning we do see that the gold dipped below 4,003 at 4295 so far. Right, I'll keep a bearish bias on the COMEX gold until it break past 4,004 resistance. So as in the US market, right, GE Vernova share price was upgraded by one of the research house, and the share price have climbed above $1,000 resistance, heading towards 120 and followed by 1,240, right? GE Vernova is a company that stands to win benefits due to the strong demand of electricity demand in the US for the due to the AI data center. As for the FKLI, we keep a bullish bias right now after it break past that 1720 resistance. So based on the Tuesday price actions, sentiment have become positive on the FKLI, and right now we are looking at the upside towards 1760 and followed by 1008. Right, on the other hand, FCPO, right, also have a very strong momentum on the Tuesday sessions, testing the 4006 level. We still keep a bearish bias on the FCPO. We think that the movement should be considered a sideways movement until it break past the 4007 resistance. Meanwhile, this morning, trading stocks, we have the Hong Leong Bank that break past 21 ringgit 80 cents. Next R1 will be at 23 ringgit and followed by 23 ringgit 80 cents. Down support is at 21 ringgit. Secondly, we have Farm Fresh that climb above 2 ringgit and 40 cents. Traveling towards 260 and followed by 280. Downside support is at 2 ringgit and 25 cents. Okay, so I'll stop here and pass on to Leon on the oil and gas report. Thank you.
Okay, so I will talk about the oil and gas wrap up. But first, I would like to give some key message is that while the recent US-Iran peace agreement has reduced concerns over a prolonged supply disruption, we do not expect oil price to immediately revert to pre-conflict levels, which is around the 67 to 70 dollar per barrel. Brent has retraced from a recent highs, like what Joseph said, but ongoing infrastructure repairs, gradual gradual capacity restarts and supply chain normalization should keep oil price supported in the near term lah. So as such, we maintain our Brent crude oil price assumption at 82.5 US dollar per barrel for 2026 and 72 per barrel for 2027 now. So the current year to date for oil price stands around 88 US dollar per barrel. So this is implying we are expecting the rest of the year to be hovering around 78 to 80 lah. So looking back at the first quarter 26 earnings season, I would say it was broadly in line. Last month, 9 companies reported with 4 meeting expectation, 1 above and 4 below. On a market cap weighted basis, the sector was supported by resilient performance from MISC, Dialog, and Petronas Dagangan. The standout positive surprise from our side was PChem, which benefited from stronger product spreads, lower operating costs, and improved operational performance. Meanwhile, MMHE, Wasco, Bumi Armada, and Sumi Saujana underperformed mainly due to project timing issues, weaker operational contributions, and margin pressure lah. So we expect second quarter 2026 to be the peak of FY26. The recent Middle East disruption temporarily lifted the both crude oil and petrochemical prices lah. So we should provide the near-term support to earnings across parts of our coverage universe with higher product spreads, with higher tanker rates as well. So, however, following the recent US-Iran peace agreement that is most likely to be signed this Friday, we expect the supply condition to gradually improve with risk premium beginning to unwind lah. So one very important data that I would like to highlight also, which I think many is unaware yet, is that the euro has already corrected back to around pre-war levels despite global utilization rates, logistics and supply chains not having fully normalized lah. That suggests that the market may have already moved ahead of the physical fundamentals and is already pricing future supply recovery. But I think it is still too early to conclude that the current urea price are the new equilibrium. The recent correction was driven by 2 factors, which is one is the unwinding of the geopolitical risk premium, and another one is the relaxation of China export restriction, which already increased the supply availability. As a result, the market moved very quickly from a pricing shortage to a pricing a much more balanced market lah. So could the urea price bounce? I would say maybe yes, if the China exports prove to be temporary, if capacity restart takes longer than expected, or if the demand remains resilient, then current price may prove to be pessimistic. However, I think it's difficult to argue for a return of extreme levels seen during the conflict, as those prices were largely driven by fear of supply disruption and significant geopolitical risk premium. But for the other petrochemicals like methanol and ammonia, they are still showing quite resilient at the moment. It's just that urea side. So another thing I want to point out is for the midstream side, the fundamental remains relatively resilient. So tanker rates were already strengthening before the conflict, supported by higher crude exports, longer haul trade flows, and tight vessel supply. So while rates may moderate from the recent peaks, we do not expect a return to last year lows lah. So for example, like VLCC is about 40K USD per day for let's just say third quarter 2025 from my back of my mind. Then this year it still should be around 100 which is still gonna be more than double. So LNG shipping markets are also showing signs of recovery from trough levels, supporting a more stable earnings outlook. So as such, we continue to favor MISC as a defensive pick within the sector. It's largely contracted fleet, provides stronger earnings visibility, while they have 35% spot rate exposure in the petroleum segment, which offers upside from the firmer tanker rates lah. So despite this recent escalation in the Middle East, we expect the tanker rates to remain supported by a healthy ton-mile demand and tighter vessel supply lah. That's all from me. I will pass on to my next colleague. Thank you.
Thank you, Leon. Hi, good morning, everyone. I do have a company update on LAC Met. So we are maintaining a buy call. There's a slightly higher target price of 1.16 ringgit. This is from 1.14 ringgit previously. So on Tuesday itself, LAC Met actually secured a sizable contract. This is at 78.9 million. This is for the supply of reagents as well as related consumables to 10 Ministry of Health public hospitals in Kedah. And the contract is for a tenure of 4 years, starting 15 June. So revenue recognition for this contract specifically will be based on actual usage of actual hospital usage requirements. And the contract, we understand that this is coming from a Abbott branded lab consumables, which typically carry slightly lower margins, which is around a single digit range. But previously, you know, since our previous report, you know, our view hasn't changed. We always say that, you know, Abbott related contract wins should be viewed primarily as a earnings accretive recurring business that actually enhances earnings visibility despite, you know, a lower margin. So we do estimate that the contract could contribute about 5 to 7 million in gross profit over its duration. This is assuming gross margins of 7 to 9%. And following this award, the outstanding order book increases to 277.9 million. Year to date, contract wins, it's at close to 106 million, all of which are still, you know, secured through this Abbott brand. Yeah, so with consumables, again, it kind of mitigates some of this cyclicality inherent in LAC Med's you know, capital equipment distribution business model. But that said, you know, we continue to expect multiple smaller equipment related tenders that will be awarded over the coming quarters, which should help cushion margin pressure as well as support earnings momentum heading into fourth quarter of 2026, which typically contributes about more than 50% of full year earnings. In terms of earnings changes, we make no changes because previously we have already incorporated some of this growth for the medical consumable segments from the newer brands. So earnings are unchanged. We did adjust our revenue assumptions upwards to reflect the larger contract sizes, but this is largely offset by a lower gross profit margin assumption. In terms of why, you know, there was a change in our target price, basically we did roll forward our valuation base year to 2027 and derive a TP based on a lower 14.1 times 2027 PE from 15.7 times previously. But both of these numbers, they remain in line with selected peers exposed to similar distribution business. So all in, we continue to view the group as a key beneficiary of Malaysia's expanding healthcare sector. We do think that there is potential for LAC to secure additional principal brands. And in terms of products that they carry, it will be complementing their existing product portfolio. That's it. You know, we do find the 9.1 times what they're trading, the PE that they're trading at, which is at 9.1 times to be weak. And you know, we advocate investors to actually accumulate on weakness. Yeah. Just to sum it up, you know, rather than focusing on LAC Med's weak start to FY26, which actually is broadly in line with expectations given the nature of the business. We do think that investors should monitor the progression of hospital tender awards in third quarter, as this will determine, again, the bulk of the earnings recognized during this year. So maintaining our buy call here, $1.60 target price. So I'll stop here. I believe I am the last speaker for today. Okay, see you again tomorrow at morning kappa at 8. Thank you all for joining.